All right, so a very, very good morning from me and the FP Markets research team. I hope we're all doing well and ready for the week ahead, the final full week of November, if you can believe that. Now, I'm going to kick things off by stating the rather obvious, the Trump trade, which as I'm sure we're all aware, is alive and kicking. US equity markets or US equity index futures gapped higher this morning. On the back of a reaction to Donald Trump's pick of Scott Bessent for the Treasury Secretary role on Friday, who you may recall called for gradual tariffs. Now, as of writing, we're also seeing the US dollar and US Treasury yields trade lower. Now, Trump and Bessent met on Friday, where Bessent recommended Trump to pursue a policy he calls 333, which can be compared to Abenomics' approach, the three arrow approach, if you will. Bessent's approach, his targets will include a 3% cut to the budget deficit. He will also aim for 3% GDP growth. And he will also target an additional 3 million barrels of oil per day. Now, as you can imagine, achieving these objectives would benefit the US economy, hence the gap higher we saw we saw this morning. Now, the reasoning behind the the drop in the US dollar and Treasury yields is that Trump choosing Bessent for the role of the US Treasury Sec will has essentially reassured the bond market, which of course pulled yields lower. So overall, with higher tariffs and Trump's pro-cyclical fiscal policy, uh, this should lead to a stronger US dollar, at least in the medium term, considering investors are also paring back rate cut bets. So look, tariffs are essentially a tax on imports that are usually paid for by the importing firm, the US firm. This generally serves two purposes. The first and most obvious is the additional revenue for the US government. And second, it helps protect or safeguard certain industries in the US from foreign firms undercutting US companies on prices. Ultimately, the nomination of Scott Bessent has somewhat calmed concerns regarding Trump's protectionist policies, which could trigger inflationary pressures and worsen trade tensions, all of which leads to both elevated market volatility and uncertainty, which can generally boost the safe haven appeal of the US dollar. So moving to the economic calendar this week, Monday and Tuesday will largely be quiet. Most of my focus will be on Wednesday's Asia Pac session, which begins with the Aussie CPI numbers and then the RBNZ cash rate decision at 1 a.m. So the Aussie CPI is at 12:30 a.m. and at 1 a.m. This is UK time, guys. We have the cash rate decision from the RBNZ. Now, as you can see, Aussie CPI data is expected to push higher. This is a weighted CPI year-over-year measure for October, is expected to push higher to 2.3% from 2.1%. Now, in terms of where we are for the for the RBA for rate expectations, now the RBA is expected to hold rates until the middle of hold rates unchanged until May of next year. So we're not fully pricing in a 25 basis point rate cut until May. While So what does this mean for the Aussie dollar? What does this mean for the Aussie dollar in terms of the Aussie CPI, the CPI inflation numbers? Probably not too much, given that we are seeing markets only pricing in, as you can see here, less than a 10% chance of a 25 basis point cut for next month's meeting. Now, we also have to take into account that the Aussie dollar is stretched to the upside in terms of the CFTC COT data. Therefore, should we see a punchy downside surprise in the data this week? So instead of coming in at 2.3%, we see a 2% a 2% print or even a 1.9% print. This could see some of the Aussie dollar, the long Aussie dollar positions unwound. Um, Look, while this may not see much of a change in terms of rate pricing, we know the RBA are expecting rate cuts. Sorry, we know the markets are expecting the RBA to cut rates. And given how stretched we are to the upside in the Aussie dollar, a short could be something to consider, assuming we do get a downside deviation in this week's Aussie CPI data. Now, in terms of where we are on the charts, look, we are coming off a descending resistance on the monthly time frame. There's no denying that. And we do have some room to move to the downside until we reach that ascending support there. Moving across to the daily time frame, we've also just come off resistance at around 65.38, with plenty of room to move to the downside until these lows of around 64.42. So there is room to move lower on the Aussie dollar. So I'll be looking for a downside surprise in the Aussie CPI inflation numbers that could potentially push the Aussie US dollar lower this week. Now, in terms of where we are for the RBNZ, the RBNZ, as you can see here, is expected to cut the cash rate by 50 basis points to 4.25%. Now, look, markets are, as I said, markets are fully pricing in. Let me just get to the New Zealand dollar. Last time I checked, markets are fully pricing in a 50 basis point rate cut. We're actually, money markets are actually pricing in 60 basis points of easing this week. And we're essentially looking at a 60% probability for a 50 basis point cut and a 40% probability for a 75 basis point cut. Look, a 50 basis point reduction in the OCR will follow a 50 basis point cut at October's meeting, and the surprise 25 basis point cut that kicked off the central bank's easing cycle, and this was in August. Now, personally, I expect the RBNZ to follow through and reduce the OCR by 50 basis points this week. Look, inflation has cooled. Let me just check my notes to 2.2% in Q3 of 24. And this essentially placed the inflation rate within the RBNZ's target band between 1 to 3%. And this is the first time since early 2021. Economic activity also remains well and truly in the doldrums. Q2 24 data showed economic activity shrank by 0.2%, and this follows a paltry 0.1% expansion in Q1 of 24. Couple this with a loosening jobs market, and I really see the RBNZ going for a 50 basis point cut this week. Now, employment data has showed a contraction of 0.5% in Q3 of 24, and the unemployment rate has risen to its highest rate since late 2020. This is 4.8% in Q3 of 24. But look, a 75 basis point cut is certainly not off the table. We certainly have an economic downturn in New Zealand. We have increased unemployment. And importantly, there is a long break between now and the next meeting. The next meeting, as you can see on the screen there, is not until the 19th of February next year. Now, with nearly 60 basis points currently priced in, there is some expectation that the central bank could swing for a 75 basis point cut, which in my opinion would likely see the New Zealand dollar trade considerably lower on the back of this somewhat surprise move. Now, a 50 basis point, assuming the RBNZ does opt for a 50 basis point cut, given it's widely priced in, this could disappoint some traders and really is unlikely to yield much of a surprise or reaction, especially if dovish language is absent, or and the OCR projections are only moderately revised lower towards the end of 2025. Now, in terms of where we are on the charts for the New Zealand dollar, as you can see here, so look, the reason I'm looking at the New Zealand dollar closely heading into this event, an outside 75 basis point cut could see the pair sell off strongly, particularly in light of investors paring back rate cuts, US rate cut bets. Markets are now pricing in, we will get to this shortly, but markets are now pricing in only around 13 basis points of easing for the Fed next month, as well as the US dollar being bolstered by the incoming Trump administration, as well as safe haven demand. So as we can see on the New Zealand dollar right now, we are testing range support on the monthly time frame at 58.46, but we also have room to push lower just slightly to 58.07 on the daily time frame towards support. Given that we are testing monthly support, range support, and we have daily support nearby, between this daily support at 58.07 and 58.46, I do expect some reaction to be seen technically, and this would align with the RBNZ cutting rates by 50 basis points. So this could be an area to keep an eye on, this support area between the monthly time frames support and the daily time frame support could be an area to keep an eye on during the RBNZ's rate decision. So moving back to the calendar, later on Wednesday, we also get the PCE numbers for the US at 3 p.m. GMT. This is something I will be watching closely, given it is the Fed's preferred measure of inflation. And the reason this is released on Wednesday, usually it's released on Thursday, is due to the US being on essentially closing their doors in observance of Thanksgiving. As you can see, PCE price index headline level is expected to increase to 2.3% from 2.1%. For the core, we are expecting 2.8% from 2.7%. So we are expecting higher numbers across the board in terms of the year-over-year numbers. Should this be the case, we could see investors further price out the possibility of a rate cut next month, which could ultimately push the greenback higher. In terms of where we are for the US Fed rate pricing, as you can see, 13 basis points of easing priced in for the 18th of December. It's essentially a coin toss between a hold and a 25 basis point cut at the moment in terms of regarding probability percentage. Look, we have seen investors pair rate cut bets quite substantially of late on the back of moderately hawkish comments from Fed Chair Powell and, of course, his colleagues. My issue with this is how much of a reaction will we see from the higher than expected print is really difficult to estimate. As next month we do have, next week we do have the US jobs data, which is arguably the more important data and for the Fed, and I do believe it will be closely watched by investors. Look, it is key, in fact. Next week's jobs numbers is key. What some investors may watch for is an alignment between the PCE numbers and the jobs numbers. So, for example, say we do see higher than expected numbers this week for the PCE data, and we do see investors moderately pare back rate cut bets. Look, if NFP also comes in stronger than expected next week, well, this could really amplify the move to the upside for the US dollar and probably see investors fully price out a rate cut for next month. Where we are on the US dollar index right now is quite interesting because on the monthly time frame, you can see we have room to move to the upside. Resistance is calling for attention at 109.33. Again, on the monthly time frame, and we've also bounced from that 50 center line support on the RSI. However, we do see a range resistance of sorts. So we have a range between here for the US dollar index, and we are now testing that range resistance at around 107.22. Ultimately, I am looking for the US dollar index to push outside of this range to the upside, and this will really open the door for a move to that resistance on the monthly scale at 109.33. So yeah, all attention for me is on this resistance at 107.22 on the daily time frame right now. But yeah, ultimately, any higher than expected data, I would expect to push higher and to really cause some trouble for any sellers at this point. I mean, look, we have already had quite a substantial bull trap at this point here. This is likely taking out a number of stoppers at this point here that have their stops above here. It's also probably trapped a number of, hence the term bull trap, it's trapped a number of breakout buyers at this point here. And they're looking to close their positions at around this point here. So yes, this will be a very important level to keep an eye on this week. Heading back to the calendar, the only other really data point I will be looking at is on Friday, the 29th of November, and this is the Euro area CPI inflation data. As you can see, headline, we are expected to come in higher at 2.4%. This is up from 2% the month prior in October. We also have the core number expected to come up, expected to rise 2.9%, up from 2.7%. Now, as you can see, in terms of where we are on the rate pricing, we are essentially, it's a coin toss at the moment between a 25 basis point cut and a 50 basis point cut. As you can see, markets are pricing around 37 basis points of easing for the next meeting next month. Look, you can see, look, economists are expecting higher prints for both headline and the core readings. So I really do not see a cut at this juncture, a 50 basis point cut next month. But if we do see a downside deviation in the euro area inflation numbers this week, so aligning with the minimum estimates of 2.1% for the headline and 2.7% for the core, this will likely see the euro punch lower, I believe, and could see investors lean more towards a 50 basis point cut. For the euro dollar, though, right now, we do have room. I say we do have room to move to the downside, but on the monthly time frame, we are testing range support at 0.516. This is a key level for me. But we have seen quite a punchy spike lower. It's likely trapped a number of bears here, bear trap, if you will. But on the daily time frame, we are testing resistance at 0.489 right now, and we do have room to move towards that support of 0.2 around 103, the figure. So we're at quite an interesting juncture for the euro. Given the spike lower on the monthly support, I would not be surprised to see the euro continue selling off to the downside to target this support, which would align with a downside deviation in the euro area CPI numbers. Look, guys, this is really all I have for you this morning. I hope this was helpful and somewhat helps you prepare for the week ahead. I will catch you all next week, and thank you very much for joining.